What's going on, everybody? It's the Real Fish Hook Trader here, James Nash. So just want to touch a few brief points here. You see what I got written up here. You're looking at $20 times 250 days, which is about how many trading days there are in a year when you take out all the holidays and take out all the other days for weekends and things like that. So what you need to do for yourself if you're going to start trading is set a goal for yourself. Now, for some people, this could be difficult, so if you're just buying stock, it's going to be very difficult to turn out 10% a day. But with options, that is actually a very easy thing to do. And it's one of the things I'm going to do this year for, definitely start in January. But from now until January, I want to see what I can do in this short month period between now, May and December. So we'll see what happens. So what you're looking at, your outcome, you want to be around $5,000 a year. So 5,250 is this, if you get, right around that. Now, if you're at 5 or 8% a day and that's all you can do, or you feel comfortable with that and you're meeting a goal of profit, so 5% of 200. So what we're doing is a $200 dollar position, say a long-term option of $200, say whether it's a strangle, a straddle, a call, a put, whatever. It doesn't. You can hold it for a day, but you want to do this one thing. All right, you want to get in and get out. You don't want to be in for months at a time, because a lot of times you can turn out 5 or 10, 15% profit in a very short amount of time. But what you want to do is you want to pick your position carefully, okay, and you want to be able to let my focus is out here. So you want to be able to get in and get out at that percentage range, right? So buy or sell a position. So if you're selling a call or a put, or buying a call or a put, or a strangle or straddle, or spread, or an iron condor, or whatever you decide, you just want to hit 10%, right? If you hit 20%, even better, but 10% should be your goal, right? At least for a short term, until you're very comfortable trading and things like that. So you got 20 times 250 days in 1 year. Your outcome should be around $5,000. 5,250 is what that comes out to. Your average $200 position. So say you put in $300, $400, $500. You don't want to put the whole amount of money in there. You want to do a $150 or $200 position. So that percentage comes very quickly. So in the smallest moves, either direction, if it's a straddle or a strangle, compensates for your profit right away. Close it. You're done. That's all you need to do. You don't need to go and shoot for 50 or 45 or 35 or 90% when those things are very capable and possible to happen. And if you accidentally got that and you close out your position, excellent. But you want to start the next day. You want to open another position. You want to have your 10 or 20% profit goal, and you want to keep hitting it. If you have some 40 and 50, 90% days in there throughout the year, then that's going to make this number bigger, okay? And that's going to be excellent for you, okay? But what you need to do is have consistency. That is the primary problem with people trading is consistency. They don't understand that, shooting for the moon every time, is a bad thing. Also, unless you're really good at it and you just, happen to be lucky or whatever you want to call it. So one thing I will say is strangles. If you're going to do strangles need to have, all right, when you break your rules, you lose, okay? When you're playing one side of a position, so let's see, one side, hopefully this is right now. God, look at that, terrible. What's going on? One-sided. You don't want this to be more than 30% of your whole portfolio value, okay? If you have a one-sided call or a put, either one, you do not want that to be more than 30% of your total value, because in the event that you run one of these, 90% portfolio value is gonna, if this goes the wrong direction, you're done, all right? And recently I made a trade like that, and it actually went very strongly against me, though all the indicators are, for the most part, were pointing to it as far as, liquidation, open interest, things like that. The volume was good. I actually averaged the position way down and got out to a very moderate number. And then what happened was there was only 2 days left, and I'm going to touch base on Strangles also with their expiration. There was 2 days left in this trade, and it went from 1,250 value to 250, and then 0. So that's what happens. That's why people, are scared to trade options. So in the event that you make a mistake, you don't follow your rules, you don't listen to your gut, etc., this will happen to you. I promise you. I'm disappointed, but then again, you know, if you've heard my other videos, you know that I started this account with like 20 bucks, added $40 every couple of weeks, got up to about 400, made a nice trade, double my money, 800 something, concentrated on options, slowly built it up to about 2,500, and made that one mistake. Good old free cannabis company. It was doing wonderful. And, you know, the irony to it is that there were a lot of people in the market that decided to drive this price back down on the expiration because it stopped at, it went down to 920, my $10 call, right? It went to had I bought a 950 put or a $10 put, I would have compensated this. But I was so deep in this position, it was like I was seeing tunnel vision, right? Mistake. Don't do that. The very next day, Monday, the very next trading day, expired on Friday at 0. Monday, the price went up to like 1045, right? So that just goes to show one thing: you need expiration time in your favor, right? You don't want to buy anything that's a week out, 2 weeks out. When you do that, if you don't sell that sucker 2 days before, there's a very low probability the price will jump. If you're out of the money, you know, say right now I've got a couple positions on SPY. The expiration's Monday, the 13th. I'm going to sell it today before market close. It's 225 right now. I'm selling those positions before market closes. I don't care what the value is. I don't care how much money I lost today or made today. I'm selling the position. Okay. Now back to that. So that takes out, you know, your whole portfolio. And I've seen, you know, I'm in a couple of chat groups. Shout out to TCX Trader Circle. Excellent learning technicals, EMAS, exponential moving averages, and things like that. I'd recommend you, go check out the chat room. It is on Discord. It's a very good platform. A lot of good people in there. Most of them make just amazing returns. It depends on your capital. It depends on how well you follow, you know, your rules, your gut. If you're just copying trades and things like that. Now, obviously, they're not responsible if you lose money or make money. I mean, all more power if you made money. But back to this. So I'll put that link below. Strangles. So you want at least 1 month or higher expiration. Now why? Why do we want a 1 month expiration? Well, here's what's going to happen. Say I bought a $50 call. Say my strike price is, this is the cost. So we'll say a $50 call and we'll keep it even, a $50 put, right? And my strike price is going to be, let's just use Ford as an example, $10, okay? So I'm buying a $50 call, and if they have it, depending on the time frame, month-wise, we'll say a 950 put, right? So say each of these positions cost me 50 bucks. My total investment is $100, all right? Say this expires in 1 week, okay? 1 week expiration. And let's say Ford just does this. Guess what? If the price is above or below one of these, you'll be okay, because that one's going to make the premium, right? So if it's below 950, so for this, it's going to be 50. So $9 is your break even here, because you're subtracting the premium you paid. This is actually $50, not 50 cents, right? So when you're looking at the option cost, that's how you read that. So this would have actually been 0.50 when you're buying it. This would have been 0.50. What's this equivalent? So your option multiplier is 100 shares on every contract. So that's $50, okay, and $50. So total in 100 bucks, all right? So say Ford stock just moved across. I love Ford stock. It's what I talk about all the time. It's very, very liquid, and it's almost, the more you look at it, it has a few pops here and there. So if you're in the wrong position in that situation, you'll get screwed. But in the event that it goes the right way or trades how it normally does in its trends, you can definitely hit it right. So say your expiration's here and the price just moved across. Well, that's going to go to 0 and that's going to go to 0. All right. If it's any number, I mean, it could be $5 here, or maybe $3 here, and you might get lucky and you can get your $8 out of the 100 that you just put up for this trade. But in the event that it pops right here up to say 1050, well, this premium on the put's going to go down anyway. But now chances if you pay 50 for it, the premium at, say we got about 2 days left to expiration, or 3 days left. We'll say 3 days. all right, and you jump really high on this call, you get out of this position now, because at this time, if it hits that 1 week expiration, these are both going to go to zero. It's not going to be above 10. If you're lucky and the market closes at the market end above $10, then your call will not expire worthless, but it's likely going to expire not worth what you want it to. You're not going to make a high premium on something like that, because it'd have to be 1050, 1075 to make a real profit on this, okay? And same thing with the put on the 950 side. So I have this short spread here, so the distance in between is what you want to concentrate on. You don't want this to be $12 and $8. Yeah, those are way out of the money calls and puts, but chances are the price is not going to move that much. Ford is actually doing pretty well. They're getting their stuff together, but let's get back to it. So don't do out of the money. I think it's stupid. If you're going to do a strangle, put a limit buy on it. So the common price for these at about a 2 or 3 month expiration, sometimes 4 month expiration. The good price to get one of these is around 30 to 40 bucks, right? I've seen them go down way lower than that, but if you go back to the other video I did with all these where I was negative like $350 or $305, and I averaged down the entire position, and I did it on this board in the other video, so you should recognize it on my videos. Anyway, that's what I ended up averaging down to. It got to about 0.23, which is 23 bucks per contract, for each strangle. So I went ahead and picked up a bunch, averaged the percentage way down, went back up to 35, got rid of them, made profit. Walked away with like 218 bucks profit, 21% I think it was. So with that being said, do not make a strangle or straddle for an expiration that is less than 1 month, okay? You want to have at least a month to 4 months. All right, that's the rule of thumb here, because if you don't, theta is the time decay of the option. So you can look at that. You can look at delta and you look at theta on your options. And when you look at the open of it, you'll see, say, most of these Fords, delta is probably going to be like $20 every dollar it moves, times however many contracts you have. So in that event, say you bought a $200 position on SPY, which is S&P 500 ETF, and you bought a $200 call, call, say for right now the price is teetering between 285 286. Say you bought 286 for 200 bucks, it goes to 287. You're automatically getting profit off of that, right? Hopefully you bought at a good position. Limit orders is what I used to preach, and I'm heavy back in that route, because when I pick up limit orders and the price suddenly drops, and it meets your limit and picks up your limit, and then it returns to its previous high or high on the day, because a lot of times in the morning you're going to see a sell-off, right? And I don't know why, a lot of people just choose to sell, especially on Fridays. And today is Friday, so as I said, that's why I'm going to get rid of my positions, because Monday anything could happen. The trade talks with China are going on right now. We don't know what's going to go. So say SPY is at 285. Sorry, not 250. Numbers all mixed up here. So 285. All right, so we want to buy a call. It's going to cost us 200 bucks. All right, so say this call is 285. Price goes up to 286.50. That's going to be a pretty good indication. Say we got a 1 month expiration, or at least 2 weeks. This is even pushing it, because in the moment it turns against you, and it's $5 out of that range, even though the SPY can move $2 to $5 all the time. You want to be on the good side of that. So say you limit bought for 200, and this jumps back up to 250. Okay, so that's $250. So you just made you just made your 10% right there, right? So 10% would be 20 bucks. So you made about 43% off of that trade. And then you close it, you get out. I'm done. Close position, 20% plus, goal, whatever. Done. Get out of the trade. Don't stay in this trade, because the moment it goes to, say, first resistance level at 286.90, and then it gets a huge turn back and drops back to 284, guess what? All your profit is gone, and this probably went down here to probably 140. 145, right? And I've seen that happen. I watched them the other day. I watched these premiums go from 130, 140, 150, jumped up to 260, 220, and then like not even 10 minutes later. Now, if you're good at watching your stuff and you're calculating, you're scalping quickly, boom, boom, in and out, done, okay? But the biggest thing I want to touch on is that I got a lot of people asking me, say, hey, I want to get into investing, where I start, and there's friend of mine, he's looking into Robinhood. He's got other, 401k retirement stuff and all that, but I recommend Robinhood just because of ease of operation. It's very user friendly. I've personally never had any issues. I had it when they had the big glitch or whatever you want to call it. A lot of people claim they lost a lot of money and all this stuff, and a lot of people on there doing that. There's no fees associated with it, so everything you do makes profit. Now, if you're trading in an account size of $50,000 or $100,000 or something crazy like that, that's high, where most people are trading with a $100,000 to $5,000 account, maybe $20,000. That's not that much in investing these days. If you're in that range, you're probably fine. But when you get up to $50,000, $60,000, $70,000, $100,000, fees should not really be your worry. You should be worried about the ability for the brokerage to always maintain integrity on the site. Technical failures happen all the time, and there's nothing you can do about it. So in the event that you bought, so a $5 share, you get a free share when you sign up with Robinhood anyway. I'll throw that link in this video. It's literally free money, like 100% free money. So you link your account, you put your social. You're opening a brokerage account. You have to put your social security number because they report to the IRS. Okay, if they didn't, what they'd be doing is illegal. So you report everything, you give your information, your income, blah, blah, blah. You put your trading experience down. If you want to be able to trade options, you have to have, in the questionnaire it asks you how long you've been trading for. Do you consider yourself professional? They ask you, are you a non-professional or a professional trader? 99% of you are going to say non-professional trader. If you say you're a professional trader, you will be marked as one. And I don't think you can take that back, because once you do, that considers that you're 100% able to trade, and that probably puts different waivers on you, I'm not sure. But if you're trade experienced when you're trying to apply for options to trade calls and puts and things like that, it has to be 3 years or more experience, so you get approved for selling calls, buying calls, selling puts, buying puts, different option orders, Strangle, straddles, etc., etc. All right, right here, say you got a $5 Zynga, for signing up, and you know what, you say, I don't like Robinhood. So you can sell this 3 days after you buy it. So in the event, let's say Zynga went up to 550, right? In those 3 days, then you sold Zynga. And you're done. You don't want to trade anymore. You don't want no part of Robinhood anymore. You sell that on the market. Now you have $5.50. Now when this settles funds. These markers are wild, man. They got this weird tip on it. Anyway, settles funds. So now you got $5.50 that's about to settle in your account. It takes about 2 or 3 days generally. You can immediately trade for this if you wanted to. You could turn around and buy, another stock or penny stocks or something like that if you want to do that, just to play whatever you want to do. Who cares? But point being, it's 100% liquid, right? So when you do that, your settles funds, you're done. You want to close it out. You transfer this to your bank. You just made $5.50 for signing up, getting a free stock from signing up with my link or whoever's, and boom, you got literally free money just for trying it out. All right, in the event that you choose to continue, then you already have $5.50 from Zynga. And I've heard of some people getting Amazon stock out of this, or Google or whatever other ones they give. I've seen 4 stock I've received, mostly Zynga, and you're capped at $500 on this. So whenever you hit $500, you can't recommend anybody else, or it's pointless if you do. So don't think I'm getting rich or anybody else is getting rich off of this. $500 for a really good trader, yeah, they can turn that into some real money. But for the majority of us that trade, constantly trying to build, portfolios or whatever, you're not going to be in that level, and it doesn't matter. So you can put $500 and buy, what's a $100 stock right now? PayPal's like 108, 109, teetering between the 115 range. So set caps for yourself. But what you could do, say you got a $500 stock, you sold it, because chances are that $500 stock is it's not going to go, much higher than that. Generally, unless it's Berkshire Hathaway or something. But say you got a $500 stock, and you sold it, and now you got $500, so you could buy 5 $100 shares, or 50 $10 shares, or whatever. There's whatever you want to do. It's your money, or you could just cash it out and you just made $500. There's really no risk to this. You know, as long as all your information is legitimate, you know, and you're not like, I don't know, illegal or something, you know, as far as you are holding taxes out of the IRS or, you know, federal government or whatever, you ain't got nothing to worry about. But anyway, so if I could say anything that sticks with you, I know I talk a lot and ramble in some of these videos, but if I could say anything, expiration, 1 to 4 months, period. That's the most important thing you should take away from this video. Because when you do this, and you're buying out of the money, chances are you might end up with that big old fat goose egg right there. And that means $0, because say you bought 2 weeks, Strangle, straddle, who cares? Say it's a straddle, right? Say you're straddling, you know, a $50 strike price and you're on both sides of it. Well, time decay is going to eat you alive anyway. Now, say that the straddle moves heavily in your favor, you know, to the downside. So say back to the forward position, say it was 10 to 950, say it went to $8. Well, in that situation, the call is going to go to pretty much nothing, but the put will likely get, you know, say it was $20 to $40 delta, which would give you this $2 move, so probably $85 profit. So that would likely compensate, you know, for that other side. A strangle is very similar, but the problem with this week, this slow week expiration right here, so 2 weeks, that's fast. You don't realize it, but that's very fast. If there's not moves popping like earnings and things like that, or something that's going to really trigger the stock to move, you're hurting yourself and you're putting yourself in a bad position. Oh, but it's cheap. That's how I feel about cheap. 90% of the time, you're going to walk away losing money. And I say that from one, experience, and two, cheap options are not guaranteed options because, you know, just think about it. Okay, say the stock is at $10. Say I want to go to, say my expiration is 4 months, right? Let's just say, what is this? May, June, July, August, September. So we'll say September expiration. All right. September expiration. So we got 4 months right there. Okay. So let's say it's $10. So I got 4 months for this stock to do any of these things. All right. Say right here, say it goes up to $11.50. Man, I'm so out of this position. It's done. That's a $1.50 premium. So depending on what delta was, that moved $1.50. So that's 2.5 parts of delta. So let's say it's $50 every dollar. No, so that's 100 and 150 basically. I'm sorry, 125. So $125 profit right here. Why? I mean, depending on how much you pay for this option, $10, you know, say a $10 call, depending on what it is, 4 months out, it's probably not going to be more than $50. Okay. So say 50 and you made $125 profit. I mean, that's ridiculous. That's excellent. That's amazing. But chances are Delta's not going to be that high. So it'd probably be, you know, realistically $85 profit, which is still tremendous. You doubled your money. If you bought $50 position for a call, price goes to $11.50. Because that's the thing. GE and Ford, they move sequentially to each other a lot of times, and this is generally what it looks like. Now, a lot of times it's in this trade pattern, you know, so they're trending. If you don't know what that is, sorry, that's a trend. So say it's slowly doing this. Well, that's up. You know, you're trending up here. Sorry, my phone's out of position. You're trending up, trending down. So Ford has one that looks a lot like this. You know, if you look at a 5-year, Ford is a lot like this. And this is like 12, 10, 8, 7. And then we recently V'd back up over here to about 10.50. And it was at 11 not long ago. This is kind of what Ford does, but you can see this, right? That is a trend line. And say it broke out of this trend line here. And it popped up back again to 10.50. So now we have a new resistance level. Okay. And your support is obviously down here. Now you want these, I'm drawing crooked right now because I don't have a ruler or nothing. But you want to be able to draw trend lines, right? You want to see where all the resistance caps are. So we did this properly. Well, actually, it's even worse than that. So something like that. So you want at least 1, 2, 3 touches. So right here we got about 4. I would have probably got that too. I'd have squeezed it a little higher. So you want trend lines. You want at least 3 touches on resistance and support. Resistance, support, okay? And you got what they call RSI. All right, RSI moves in and out of here. Say this is 70 and 30. All right, this is overbought, oversold. Sorry about my writing, guys. I'm trying to write fast and do this. So overbought anything above 70, oversold anything above below 30. So it would drop back down here. You're oversold. All right, now what does that mean? Well, RSI is basically a relative strength index of the moving averages of prices. And with that being said, if like right now on the short term, the S&P is oversold. Short term on a, let's see, a 1 day, 5 day, 10 day, SPY, overbought, not oversold, I'm sorry, overbought. So that means there's a high probability that in the next few days, this price is going to go back down. So right here is 287, 286. We're going down here. Say it's 275. I'll make some hella money. But anyway, cutting this video off now. About 26 minutes of your time. Thank you, the Real Fish Hook Trader, James Nash. Hope some of this helps somebody. Thank you.